Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at trading-pennies.com. In our first videos in this series, we demonstrated how to use information available on websites to develop your initial stocks watch list. In the second video, we showed you how to set up multiple time frame charts using moving averages most commonly used by professional traders. In this video, we're going to begin to look at the most profitable chart patterns that you need to become familiar with to become successful trading the penny stock market. As noted previously, technical analysts believe that all information is reflected in the stock's price and that trend and sentiment changes precede and predict future price movement. Traders' emotional responses to these price movements lead to recognizable chart patterns. A trader uses these historic chart patterns to anticipate future price movements, believing that basic human nature, fear and greed, repeats itself over and over again, and a stock chart is a reflection of these two emotional forces in action. Since these chart patterns visually represent market psychology, you need to be able to recognize and anticipate their formation. You also need to keep in mind that each pattern does not act in a vacuum by itself, but instead coexists alongside, within, and among one another, and does so on multiple time frames. Since all traders utilize different technical data, chart patterns, and time frames to make their trading decisions, you have to be aware of all of them so that you can capitalize when they all converge and traders act in mass to make enormous profits. Thus, chart patterns are an important tool we use to make profits in the market, and the following chart patterns have proven to be the most successful and profitable in history, and therefore need to be recognized by those who wish to truly succeed trading. The first pattern we'll look at is support and resistance. In the market, support is a price level where buying pressure overcomes selling pressure, and as a result, the trend in the stock that had previously been declining is turned back up again. Thus, a support level is visually recognized as forming a prior low or valley at or near the same price level as the previous low or valley. A support level increases in psychological significance or strength the more it is proved to successfully change the trend of a stock when approached from above. In the chart illustrated below, you will notice that the 0.12 price level serves as strong support, as each time the stock approached this level from above, it was turned back upward on 3 successive attempts. As a trader, when a stock nears the support price level, we want to put this stock on our watch list as it may prove to be a very profitable trade. Resistance is the opposite support and represents a level where selling pressure overcomes buying pressure, and as a result the trend in the stock that had previously been in an incline is turned back again. Thus, a resistance level is visually recognized as forming a high or a peak at or near the same price level as a previous high or peak. Like support, resistance levels increase in psychological significance or strength the more it is proved to successfully change the trend of a stock when approached from below. In the chart illustrated below, you will notice that the 0.20 price level serves as strong resistance, as each time the stock approached this level from below, it was turned back and declined on 3 successive attempts. As a trader, when the stock nears a resistance price level, we want to put this stock on our watch list as it may prove to be a very profitable trade. Support and resistance levels are one of the most basic but profitable patterns that traders should learn to master, as it represents the heart of market psychology, a point where there is a potential change in the balance between fear and greed. While the prior examples represent support and resistance levels formed by specific price points, in this case the 0.12 and 0.20 respectively, you have to understand that support and resistance levels are formed by many things. Moving average lines, trend lines, consolidation highs and lows, cup and handle or saucer pattern highs, gap levels, and volume climaxes, and that all of these occur within multiple time frames. Moving averages are commonly used by the majority of traders when making their trading decisions. As a trader, you have to understand what moving averages are used by the majority of traders and in which time periods. To use moving averages, you have to understand the prevailing trend. If the moving average is rising, the stock is in an uptrend and in that time frame. If descending, the stock is in a decline in that time frame. In general, if a stock pulls back into and moves upward from an underlying and ascending moving average, that moving average is serving as support. If a stock moves up into and moves downward from an overhead and descending moving average, that moving average is serving as resistance. We at Trading Pennies have presented you with the most commonly used moving averages by professional traders in our manual and discussed this in last week's video in our discussion of setting up multiple time frame charts on your trading platform. As an example, the 20-period moving average is used by the majority of professional traders using a daily frequency. You can see in the chart below that it serves as strong support, as each time the stock advance pulls back into it, it is turned away as buyers come into the stock and it continues its advance. On this chart, you can see how the 20-period moving average on the monthly frequency served as strong resistance. As each time the stock advanced from and approached it from below, it was turned away as sellers came in to either reduce their position or take a short position in the stock. To illustrate multiple patterns in action, let's look at the following chart. Notice that while the 0.05 price level serves as strong support, the overhead and descending 200-period moving average served as strong resistance. As a trader, armed with this new information, as the stock nears a clearly defined support and resistance level, we want to put these stocks on our watch list as they may prove to be a very profitable trade in either case. The information we have discussed so far has to be taken into account when determining whether or not to take position in a stock. It also has to be taken into consideration when determining when to exit a trade, to take partial or full profits, or to prevent or minimize loss. Support and resistance, for example, are what are known as key pivot points. A key pivot point represents a point or a price level where potential change in market psychology may occur. It is at key pivot points where the potential to make explosive profits are greatest and where we will watch the price volume action very closely determine our next course of action. When going long or buying a stock with the anticipation that the price will rise in the future, we want to take position in a stock if there is volume that comes into the stock as it moves off a support level, or if volume comes into the stock that breaks through a prior resistance level. Now, this will be discussed in greater detail later in this series, and is also discussed in detail in our manual. Another pattern of support and resistance level are trend lines. Trend lines are lines drawn across prior peaks formed by resistance levels, or valleys formed by support levels. As previously discussed with support and resistance levels, a trend line gathers psychological significance or strength the greater number of times it turns a stock away, whether approached from above or below. In the chart illustrated below, you will notice a white line drawn across 4 prior peaks or resistance points and represents a downward trend line. This trend line has strong psychological significance to traders, as each time the stock approached it from below, it was turned back on 4 successive attempts. As a trader, when a stock nears an established trend line, we want to put this stock on our watch list as it may prove to be a very profitable trade. To further make our point of being aware that chart patterns don't occur in a vacuum by themselves, notice how the yellow moving average also serves as a point of resistance to the stock's price movement. This is important because some traders will use trend lines, some will use moving averages, and others will use both when making their trading decisions. If we are to profit, we have to be aware of this and watch the market psychology at these key pivot points. Until next week, from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock market.